Come back 42 minutes after the hour. Breaking just minutes ago, the Consumer Price Index is out and shows inflation rose 0.2% in July. The report also showing that inflation rose 2.9% compared to this time last year. It's the first time since March of 2021 that the year-over-year rate is below 3%. Joining me now is business journalist and host of the What's Bugging Me podcast, Dennis Kneale. Dennis, good morning.
Good to see you, Nick. Well, these are kind of surprisingly a nice little upside surprise, right? You know, the weird thing about these numbers when they come out is it's not the number that they report. It's, well, what was the expectation? And that 0.2% you cited, that was as expected. But then that versus a full year ago, 2.9%, that was less than expected, lower than expected. The expected number was 3.0%. Now that is going to make people feel good, because what they then look to next is, now that that was better than expected and inflation year over year is lower than expected, then the Fed can go ahead and cut interest rates, which have been at 10-year highs, right, because of inflation. And so the Fed had already indicated that, you know, come September, we're going to cut rates like maybe a quarter point. The market then was thinking, what about a half point? Now you watch, Nick, some observers are going to say, hey, man, look at that good number on that inflation, better than expected. The Fed ought to go 3/4 of a point in the September meeting, which would then really set up a market rally even higher.
So, Dennis, what's your takeaway? Is this just a big yawn right now? Don't read too much into it?
Oh, no. It's important to watch all of these things. And the markets, the bond markets already are reacting to this. This is very important stuff, but it's this expectations game first. Was it better or worse? And then it's, well, what would the Fed do as a result of those expectations? Because if the Fed will cut interest rates, then that can help the markets, because money flows, money wants to grow, and it runs to wherever things can earn more. And if your interest rates on bonds go down, the money kind of wants to flow over to stocks and balance. But when interest rates on bonds, especially government bonds, went up to 5%, 5.5%, with no risk at all, almost no risk the government will go bankrupt, you want to put money in bonds. Well, now with interest rates going down and the Fed kind of forecasting interest rates going down, again, expectations, it can allow more of that money to flow into stocks, lift the market. And, you know, you'd said in your tease, does this benefit Trump or Kamala?
Right.
The better the stock market does, the better it is for the incumbent.
And you and I both know that the economy will play a role in the 2024 election. Dennis, I've got less than a minute, but polling right now shows that voters trust Kamala Harris with the economy slightly more than former President Trump. Does today's report give you any advantage either way for either candidate?
Okay, first on that poll, I call bull spit. There's no way, truly, in any poll of intelligent voters that Kamala is better on the economy than Trump is. It's just ridiculous. I would like to look into that sample and see if it was heavily weighted toward Democrats. This is just part of that whole Kamala joyfulness going on there, and it's overdone, and it's just entirely wrong. I'm just rejecting it out of hand there. I'm drunk with power.
Well, I guess I already know what the subject of, well, what's bugging me will be this week. Dennis, thank you so much for joining me this morning.
Thanks for watching, everybody. Go to joinnn.com to find NewsNation on your television provider. Also, don't forget to click that red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.